hearing all of your questions today about sales tax. Compliance can be a somewhat dry topic, so feel free throughout the course of the webinar to post your questions in the chat, and we're happy to answer them. We'll pause after to the end of each section to see what's come up about how certain topics might apply to your particular business case, whether that's about taxability or invoicing or nexus or all of these complex topics in the US. Please try to make this as interactive as possible, and we look forward to getting started here. So without further ado, I'm going to go ahead and start, Benj. So if you could start advancing the slides, we'll get going. So this is just a little bit about Commenda. We do a lot beyond just indirect tax. We do entity management for large companies that have large structures of like 100 plus entities, let's say. For subsidiary management, we do transfer pricing, we do tax and accounting, as well as a marketplace of additional services, mostly for secretarial compliances and things of that nature as well. We also don't just do sales tax, we do VAT and GST globally as well, so we have a unified solution for those. But enough about Commenda, let's dive into today's topic. What are we going to talk about today? So we're going to cover the basics in the first couple sections. What is a sales tax? Who's required to collect it? Who administers sales tax? And then we're going to get into some more complicated topics towards the second half of the presentation, where we'll discuss tax sourcing, the tax base, and the tax compliance process as well. So like I said, please feel free to post any questions that you might have about how these topics apply to your business, and I'll be sure to answer those as we go along. Next slide, Benj. Keep going. What is a sales tax? So there's sort of four key elements to a sales tax. Like VAT and GST taxes globally, it is considered a consumption tax. It's paid by consumers when they purchase a taxable product or service, but it's collected and remitted to the government in most cases by the seller. The other thing to note is that in the US, sales tax is typically, or list prices are typically tax exclusive, meaning if I go to the checkout, I go to the grocery store, I buy something that's $100. When I go to the checkout, the tax is going to be added on top of the $100 sale price. It's not included in that list price for goods. We get a number of foreign sellers who are just getting set up with their US sales, and this is a kind of a confusing point for them because they think that, the tax should be included in the US. Well, certainly you can do that. It is pretty uncommon, and it's a totally expected business behavior that, the list price for your product or service is not going to be the final price paid by your buyer. There will be tax added onto the invoice, and that is standard practice here. Sales taxes apply to gross sales, not profit. So it's calculated on the total transaction amount. So if you have a super thin margin, that won't necessarily, it doesn't mean that you'll pay less tax necessarily, so it's important to keep in mind. So even if you're not making a profit on the sale, the amount of tax owed still remains the same. Go ahead to the next slide, Benj. I already covered point 3, which is that it's typically added at the time of a sale, which is a bit different than VAT and GST countries. And point 4 is what we'll spend most of the rest of this presentation talking about. Sales tax vary dramatically by location, and there's a lot of different jurisdictions in the US. So in Commenda's database, for example, we have over 44,000 sales tax jurisdictions in the US. Jurisdictions can be as small as a single building or as large, in some cases, as an entire state. So what that means is that the rates vary as well. Because there's so many jurisdictions, each jurisdiction can apply their own sliver of sales tax with their own rate. Those rates, when you add them up, mean that there's a lot of different rates you need to apply depending upon the location of you as the seller or of your buyer, as the case may be, and we'll talk about which case applies when. So it's very important to note that it does vary dramatically by location, and that there's a lot of these unique jurisdictions and rates. It's not a simple process in order to figure out exactly what the rate should be wherever you may be selling. All right, let's continue, Benj. Let me pull up the chat. So if you have any questions come up, feel free to post those, and I'll be checking that as we go. Doesn't look like we have any so far. One thing I like to note is that there is a lot of state-specific terminology for sales taxes. I pulled a few examples here. Arizona refers to it as a transaction privilege tax. New Mexico and Hawaii refer to it as the gross receipts tax and general excise tax. Colorado, my former home state, calls it the occupational privilege tax, and Illinois calls it the retailer's occupation tax. For all intents and purposes, these are all just sales taxes, and that's the term we'll be using today. But it's worth noting that if you're ever navigating around a state portal, they might call it something different than just sales tax when it is functionally the same thing. Go ahead, Benj.
Looks like there is a question from Thomas in the chat. Are there exclusions? For example, in Australia, where he's at, water, milk, and fruit are
Yes,
excluded.
so there are certain products and services that are non-taxable. I'll talk in more detail about that. I think it's section 4 or 5. We'll talk about what is taxable and what's non-taxable. But yes, similar to VAT and GST systems, there are things that are considered non-taxable, and we'll talk about what those are in a little bit more detail. So I do like to compare and contrast sales tax versus VAT and GST systems. So VAT and GST are what we call multi-stage taxes, meaning that they apply at each stage in the supply chain, so from manufacturer to wholesaler and wholesaler to retailer and so on. In the US, that's not the case. It's what we call a single stage tax, meaning it's only charged on the final sale to the actual consumer of a good or service. Any sort of intermediate sales, whether you're a wholesaler, or if you're an input producer, are generally not taxed. And there's a way that we handle that through what we call exemption certificates. So even though that sale is not obligated to collect tax, you still have to prove it to the auditor in the event that you get audited by a state that, hey, I made this sale, but here's the exemption certificate I collected from my buyer indicating that this sale was for a resale purpose and therefore no tax could be collected. So just because you are not selling to the final consumer, that does not mean that there's no obligation for you to do some record keeping here in the US. You still want to keep good records that you can prove that you weren't obligated to collect tax in those sort of scenarios. That sort of is where our equivalent of input credits come from. So you have input credits in VAT and GST systems. In sales tax, there's no such thing as an input credit, but if you are selling goods for specific purposes, like for resale, which is most relevant, then you typically don't pay any sales tax whatsoever. You just need to collect that exemption certificate from your buyer. And we'll talk in more detail about what that process looks like a little bit later on. And I already said previously that typically VAT and GST, the tax is included in the list price of an item. In the US, it's almost always excluded. One of the reasons it's beneficial to exclude sales tax from the price is because, like I mentioned before, there's so many different rates. Depending upon where you're selling and the location of your end buyer might be, it's going to affect your margins, right? Because you might be selling at 7.5% to one buyer and the next buyer is, an 8% or something, right? If you're pricing your products as tax inclusive, it's going to actually affect your margin because you don't have one standard rate for, the entire country, as is common in, many foreign jurisdictions. Let's go ahead, Bench. It looks like Bhavin asked, we get resellers certificates from customers. That's correct. So if you are selling to a reseller, you should request a exemption certificate from them before you process the invoice. Many states have grace periods, so you can wait up to 90 days until after a sale in most states in order to collect that exemption certificate. As long as you have that on file, you're covered from the state's perspective. All right, who is required to collect sales tax? So this depends on whether you have sufficient connection to a state. And this is what we legally refer to as nexus in the US. This is similar to like establishment concepts globally. In the US, we call it nexus. If your business has nexus in a state, that state can require you to register, collect, and remit sales tax for sales to customers in that state. So what is nexus? It means a link or presence that a state recognizes as enough to impose tax obligations on your business. Traditionally and historically, this meant having a physical presence in the state, like an office, store, warehouse, or employees. Today, as of, I believe the court case was in 2017, it can also be established what we call economic activity or economic nexus, like surpassing a certain threshold of sales revenue or number of transactions into a state, even if your business has no physical presence whatsoever. We'll talk about both of these types in more detail in the next couple slides. Go ahead, Benj. So the first one and the more simple one we'll talk about is physical nexus. If your business has a physical presence in many states, that automatically obligates you to go ahead and get registered for sales tax and begin tax collection from your buyers. So there's two broad categories of physical nexus. On the left, you can see we have temporary presence, and on the right, we have permanent presence. Permanent presence is pretty simple. Office, store, warehouse, distribution center in a state, having sales employees or sales agents working in a state. Even remote employees in many cases can establish permanent presence. And lastly, owning property in a state as well. So this can include equipment, inventory, or even having a corporate subsidiary that's registered in that state, all qualify as permanent presence. It's the temporary presences that are a little bit trickier. So this can involve things like regularly sending sales representatives to meet clients or attending trade shows in a state. It can involve delivering goods in company-owned vehicles into a state, or storing products in third-party warehouse or fulfillment centers. And this is kind of the tricky one. Like if you are using a third-party logistics provider or even Amazon FBA, and they are moving your inventory into a state, even though you don't necessarily control exactly which warehouse they put it into, because you still retain ownership over your inventory, it does technically qualify as a physical presence and therefore can trigger an obligation for you to get registered. All right. The next and more recent type is what we call economic nexus. So I was off by a year. This is a relatively recent concept as a result of a court case that occurred in 2018 called South Dakota v. Wayfair. This allowed states to enforce sales tax collection on businesses even with no physical presence if they exceed a certain economic threshold of activity in a state. In most states, that economic threshold is $100,000 in sales or 200 separate transactions, but it does vary state by state. So in New York, for example, the threshold is $500,000 in sales and 200 individual transactions. You have to exceed both of those thresholds independently in order for you to have this obligation to get registered. And so that's an example of a state that has a higher threshold. I think Texas and California are other examples that have a threshold set at $500,000 rather than at 100. Almost every single state has adopted this concept of economic nexus since 2018. And this really is an attempt by states to level the playing field between in-state and out-of-state sellers. You can imagine that if you're a seller in Georgia, and Georgia is imposing a sales tax on the sales of goods that your business is making. Meanwhile, next door in Florida, there's no sales tax, or this is actually common in Washington. I'm sitting in Washington State right now in our Seattle office. Seattle has sales tax. Oregon, which is the state next door, does not. It's a burden on the Washington sellers to have to compete with those sellers in businesses who are one state over, who don't necessarily have an obligation to collect sales tax. And so this levels the playing field between those sellers in Oregon who are selling remotely into Washington versus those sellers in Washington who are already here and have physical presence. That was sort of the goal behind economic nexus. Let's go ahead and proceed, Benj. So here we have a map of all of the thresholds by state. So you can see a lot of the states have a threshold of $100,000. Some of them have an additional threshold that involves you exceeding both $100,000 in sales or 200 transactions, and some have $100,000 and transactions, 200 transactions. So that means in the or states, you have to exceed either the $100,000 threshold or the 200 transaction threshold. And the and states, you have to exceed both of those in order to be obligated to get registered. And then you can see there are some additional states as well that have higher thresholds. So the reason that getting the tracking nexus can be a little bit tricky is because you do have all of these state-specific thresholds. It's not like you take all your sales into the U.S. and you add them up and figure out, if you need to get registered. It's a state-by-state calculation, and that calculation gets even a little bit trickier because states have different evaluation periods for these sales. So some states will look at the rolling 4 quarters. Some states will look at the previous or current fiscal year. The state of Illinois is a weird one. They look at the year ended September 30th. So in addition to looking at the thresholds on a state-by-state basis, you also need to look at the evaluation periods that they're going to assess you on. Now, why do you want to do all this? It really pays to be proactive with your sales tax registration by tracking your nexus. So at the end of the day, sales tax is owned by your end consumer, not by you as the business. But if you don't get registered and start collection, then the state still can come after you for that tax that you didn't collect, right? So we get examples of a lot of Canadian sellers, for example, who, they just start selling in the US, they figure it'll be similar to Canada. They start making sales, and then, they wait a year or two, and all of a sudden they realize, or they, potentially get contacted by the state saying, hey, why aren't you registered for sales tax? And all of a sudden, not only do they have to pay all of those taxes essentially out of pocket at that point, but they also accrue interest and penalties on top of the original amount of tax owed. So you can avoid all of that headache by just getting registered proactively. That way, you can start tax collection on a timely basis, and you don't get into these situations where you're owing, huge amounts in interest and penalties. Let's go ahead, Benj. So what happens after you establish Nexus? You need to register for a sales tax permit. You need to start tax collection on taxable sales. If applicable, you need to manage exemption certificates. And lastly, you need to file returns and remit tax. It's important to note that item 2 sounds simple, but it can be a little bit tricky. So you need to actually set up your billing invoice process to account for this collection piece, right? Let's say you have an online checkout for your business, right? You're going to want to integrate some kind of real-time calculation into your online checkout flow. That way, your customers can obviously fill up their cart, they can check out, the tax will be applied on the cart before they go ahead and submit their payment, and then you're collecting it directly through your checkout experience. Because unlike most foreign countries where you just have a standard rate that you can apply on the same cart, you need to get the unique rate for that customer on every single user or checkout experience. You'll need to set that up and integrate it with your billing or your online checkout system so that you can calculate those rates accordingly. On point 3, what I would note is that this is really mostly relevant to B2B sellers. If you're selling direct to end consumers, you typically are not going to need to collect exemption certificates. But if you are making B2B sales, particularly to resellers, then this is where managed exemption certificates comes into play. And exemption certificates also sound simple, but again, this is sort of a 50-state problem where if you are selling to a buyer who has multiple locations, that buyer might need to provide you with 10 different exemption certificates. So we were to give an example, we had a Canada-based seller who was going to start selling to a big box retailer here in the US. That big box retailer has locations in essentially every state, and they then needed to collect exemption certificates from that retailer in every single state where they intend to purchase goods from the seller. So just because it's one customer, it does not mean one exemption certificate. It means one exemption certificate per state, and these exemption certificates can expire. So you're going to want to make sure that you're staying on top of your record keeping here. Commenda does offer solutions for this, so we can help you not only get those exemption certificates, but also alert you when they're going to be expiring. I think our largest exemption certificate user right now has something like 5,000 or 6,000 exemption certificates that they're managing. So the scale of the exemption certificates can grow, and it's not something you're going to want to handle manually beyond a handful of certificates. Let's go ahead, Benj. So we'll talk a little bit more about the registration process. So when you're registering for a permit, you'll typically do so with the state's tax authority. This is often the Department of Revenue, although there's different department names in different states. And you need to start collecting tax on taxable sales. This means, like I said, updating your billing or invoicing system, whether that's an online checkout system or some kind of manual invoicing system using a software. Go ahead, Benj. We already discussed managing exemption certificates. And lastly, you need to file returns and remit tax. So when you receive your sales tax registration permit, the state will assign you a sales tax filing frequency. This could be monthly, quarterly, or annual. The most common is quarterly, and the frequency is determined by your estimated annual sales. So as part of the registration process, you'll say, we expect to do $100,000 in annual sales into California this year. The state will say, great, your assigned frequency is quarterly. If your sales grow or decrease over time, the state will then send you a notice letter saying, hey, we see that your sales have increased. And now instead of filing quarterly, you're obligated to start filing monthly, and then they'll switch your frequency. So it's not like you can just put a lower number and get a less frequent filing. They will adjust it according to the amount of revenue that your business is doing over time. Looks like we have a question. Once customers have multiple branches in different states, do we need to get exemption certificates for each state for one customer? Yes. So it's typically one exemption certificate per state that you'll need to keep on file in order to make sure that you're covered. Okay, so now we're going to talk about who administers sales tax. And this is the source of all the complexity in the US. Unlike VAT and GST systems, there's no single national authority for sales tax. It's governed at the state and local level. There are 45 states plus the District of Columbia that collect sales tax. There are 5 states that don't. And these 5 states that don't have a sales tax we refer to as the nomad states. These are New Hampshire, Oregon, Montana, Alaska, and Delaware. Alaska is one that I would sort of caveat. While there is no state-level sales tax in Alaska, there is local-level sales tax in Alaska. So there is sort of an additional set there. Go ahead, Benj. So, like I mentioned at the beginning of the presentation, there are over 44,000 separate tax jurisdictions in the US. I have just this map of Michigan's jurisdictions as an example. So this is directly from Comenda's database. Every single jurisdiction uh, in the state of Missouri here that has a separate sales tax, and all of these little colors are separate sales tax jurisdictions. So if you're in St. Louis on the eastern side of the state, you might be in up to 5 or 6 jurisdictions at once. So you'll have a state level sales tax, you'll have a county level sales tax, you'll have a municipal level sales tax, a city sales tax, and then sometimes what we call an STJ, or a special tax jurisdiction, which is used to fund things like the fire department or police or ambulance or things of that nature. So when you're calculating sales tax for a buyer who's located in St. Louis, you're going to need to account for all the little rates that are applied by each one of those jurisdictions and make sure that you're getting the total blended rate that is relevant for that location of that buyer. This is where it comes in handy to have a sales tax calculation and automation solution like Commenda, because looking these up is very onerous and you probably don't want to do it, to be entirely honest. Great, go ahead and advance, Benj. Looks like we have an additional question. Is there an order on the percent applied to an invoice, like the tax percent I think he's referring to? And do I need to separate out the percentages so that I can identify county versus state tax obligations? So to answer part one, no, there's no order on the percentage. It's just like the blended rate. You'll add up all the different jurisdictions that your buyer might be located in, and that's the amount of tax that you'll apply on the invoice. There's no obligation to break out the sales tax amount on the invoice by jurisdiction. You can just give one sort of aggregate or summed up rate and apply that on the invoice. You don't need to break it out by jurisdiction. Go ahead, Benj. So we're going to talk about sales tax versus seller's use tax. So when you're selling within a single state, this is typically what we refer to as a classic sales tax. This is an intrastate transaction. When we're talking about interstate transactions, meaning you're either selling between states or you're selling from abroad into a state in the US, this is what we typically refer to as a seller's use tax. And for most foreign sellers and for most, business use cases in the US these days, seller's use tax is more relevant. This does come up when you're registering for a sales tax permit. Many states will ask you whether you're registering for an in-state permit, which is sales tax, or for seller's use tax, which can be an out-of-state permit. Just wanted to point this out, and we have an example on the next slide. So sales tax, we can see, is on the left. If I'm in Arizona and my purchaser is also located in Arizona, this is what we call a sales tax. Seller's use tax is when you're selling between states, as in the example on the right, or from outside of the US into a state. Go ahead, Benj. We also have a distinction between what we call origin and destination-based tax schemes. So origin-based sales are taxed at the seller's location. 12 states have origin source tax schemes. Destination-based taxation, on the other hand, determines the applicable rate based on the location of the buyer. So this is the majority of states. And we have another example on the next slide. So we can see an origin-based example here. If I'm a retailer in Chicago and my buyer is located in Springfield, Illinois, the rate to apply on that invoice will be determined by your location as the seller or the retailer in this example. In a destination-based state, in the example we have on the right, if I am a seller in Reno and I'm selling to a purchaser in Las Vegas, the rate of tax to apply on the invoice is determined by the location of the buyer in Las Vegas. If you are selling between states, let's say you're selling from the UK into the US directly or from Canada into the US, destination-based sourcing is the only applicable scheme. Origin-based only really applies when you're selling within a single state. Go ahead, Benj. Great. So now we're in our penultimate section here. We're going to talk about the tax base. This is where we'll discuss those concepts of products and services taxability, what is or isn't taxable. This is where a lot of the complexity arises in US sales tax. So broadly, we have two big categories of within product taxability. We have physical products and then we have services. So physical products are typically what we refer to in the industry as tangible personal property. This is just physical goods. All states tax TPP, is the shorthand for tangible personal property, but there are state-specific exemptions for physical goods. So, for example, food, medicine, sort of wellness things that you would typically expect to be exempted or have a lower rate globally, we generally exempt those in the US as well. And these are very product specific. Even within products, though, there can be a lot of complex scenarios. So I think, to give you an absurd example, I believe in the state of Pennsylvania, they tax energy drinks over 5 ounces, but not under 5 ounces, for example. So even though states broadly do apply a tax on physical products, there still can be certain very specific definitions of these products that you need to keep track of. The even more complicated categories when we start to talk about the taxability of services. So certain states don't tax services at all. Some states take a very narrow definition of what's taxable, and that really only applies to physical products. Other states take a much broader stance, and they tax both physical products and services as well. And then services have very specific definitions. So I have a few examples here. In Florida, for example, cleaning the inside of a window is considered a janitorial service, which is taxable. But cleaning the outside of a window, the outside of a building, is custodial, and that's non-taxable. So you can imagine scenarios where one vendor might do both. How do you apply the taxability? Another example is the definition of a rug versus a carpet. So a rug is a consumable good, whereas a carpet is a building product that touches our four corners of the wall. The carpet is typically non-taxable, and the rug is typically taxable. All of these different definitions vary state by state. So it's not just that there's complicated definitions in a universal sense, but a service that might be taxable in one state is not necessarily taxable in another state. And so whenever you're raising your invoice, not only do we need to look at, what is your location as the seller, what is the location of the buyer, what are the rates that need to apply for the relevant jurisdictions, but also how do you capture the product taxability or non-taxability of the good or service based upon the location of the buyer or seller. So you make sure that you get it right. And then in Florida, you're not taxing something that should be exempted, whereas it might be a different scenario in another state. So this is where a tax engine or tax solution like Commenda comes into play. You certainly can look all this stuff up and apply it manually. It's going to get pretty unwieldy to do so given the complexity, because the definition of taxable and non-taxable can vary state to state. And with a service like Commenda, all we'll do in order to make this really easy is we'll take your entire product catalog. For each product, we'll assign what we call a tax code. That tax code will then determine the product taxability the next time you raise an invoice. So let's say you're selling B2B SaaS, and I'm raising an invoice into the state of California. The next time you raise an invoice, whether that's an online checkout or in your invoicing or billing system, whether that's QuickBooks or NetSuite or whatever your invoicing tool is, we'll look at the buyer and seller addresses on that invoice. We'll look at all the product lines that are listed on the invoice as well. We'll match up those products with their corresponding code in our system, and then our system will go back to your invoicing tool and apply the correct amount of tax automatically. I mean, all of this happens in under a second. It's very fast, but those are essentially the steps that our system is thinking through in order to determine whether tax needs to be applied or not on one of your invoices. Great, we'll keep going. It looks like we did have one additional question come in. Do we need one accounting firm if we plan to set up a company in the USA to do sales taxes for other states? So you typically don't need a traditional accounting firm for sales tax. In fact, many accounting firms don't like doing sales tax because they're not set up for this complexity or to integrate with your checkout experience. You can use a tax engine like Commenda in order to make the calculations that you need. And then we also provide the filing service as well. Certainly accountants can do the filings, but it's typically not their core competency, right? They're often doing a little bit more of strategic accounting, bookkeeping, things of that nature. And then sometimes they will do the sales tax, but it's not what they're typically known for. So Commenda actually works with a number of accounting firms here in the US, for example, and they often refer to their sales tax business to us so that they can focus on the bookkeeping and sort of financial accounting. And then the sales tax is something they outsource to a dedicated solution provider like Commenda for sales tax. So great. On this slide, we're going to talk a little bit about exemptions, deductions, and dropshippers. So previous slide, we talked about product and service-based exemptions to the taxability of goods. There's also customer-based exemptions. So we talked about one category, which is if you're selling to a reseller, that's typically exempt from tax collection. There are other categories that are exempt as well, though. Those are typically things like nonprofits, charities, schools, if you're selling direct to the government. All these different types of businesses are exempt in most cases as well, and they will have a corresponding exemption certificate that you can collect from them whenever you raise an invoice. There are also certain very large sellers that have what they call a direct pay permit. So let's say you're selling to IBM, for example. IBM might say, hey, we understand our taxability better than you do as the seller. We've applied for a direct pay permit from the state, meaning that we will assess our own sales and use tax and report directly to the state. Therefore, you no longer have an obligation as a seller to collect sales tax from me. Here's my permit, remove the tax from my invoice. That's what we call a direct pay permit. That's pretty uncommon, frankly. The most common exemption certificate by far is going to be for resellers. If you have one of these other scenarios come up, it's certainly possible, but it's not going to be common for most types of sellers and businesses. Lastly, we talked a little bit about exemption certificates, the management of them. Like I said, we've got sellers who have 5,000 or 6,000 of these that they're managing. It can be pretty unwieldy. It's nice to have a solution like Commenda to help with the record keeping for these exemption certificates. We'll sync all of your customer information, and then you can associate exemption certificates with those. We'll alert you when they're going to expire, and we can also help you run an email campaign to your buyers as well, so you can collect the exemption certificate from them automatically rather than needing to manually request it every time you're raising an invoice. So it's kind of a handy thing to save some time for your back office team. Great, let's go ahead, Bench. Looks like we had one question. Can I integrate other systems to Commenda? I sell a SaaS booking system that I want to bring to the US. Can we just hit the Commenda's API to return the tax amount? Yes. So Commenda has, I think, truly one of the best APIs for sales tax anywhere in the US. Will have more functionality than just about any other provider out there. We are, a tech company at the end of the day. So yes, you can call the Commenda API directly in order to get all these tax rates, even to do the filings. You can do that over API if you really want to as well. Of course, you can do that via the dashboard experience if you'd like. We also offer about 30 to 40 different integrations out of the box with things like WooCommerce, PayPal, QuickBooks, Xero, NetSuite, Zoho, FreshBooks. I mean, there's a whole bunch of them that we support out of the box where we can integrate directly with your payment platform or your accounting software. And that way the sales data will sync directly without you needing to do any sort of manual upload into our system.
Looks like Robin, just above that, asked a question about did you say vendor tax program?
I don't think I said vendor tax program. I think maybe you're referring, I was talking about direct pay. Could you provide a little more context, Robin? And while I wait for your follow-up, I'll go ahead and keep going here. So we already talked a little bit about the registration process. It's kind of like getting a driver's license. It's regulated and mandated. It's going to require pre-approval from a state agency. You have to keep a valid permit, and then if you do this wrong, there are civil and criminal penalties, right? It is sort of a privilege to sell at the end of the day into a state. It's almost always done online these days. Typically, you can get it in many states like the same day or within like 1 or 2 or 3 days. Certain states, that'll take a little bit longer because you have to receive a physical piece of mail. So like New Jersey and Utah are the ones that come to mind where it might take 2 or 3 weeks because you're waiting on a physical piece of mail before your permit is issued. And then after that, you'll be issued a permit number, a state assigned filing frequency, and that is when you're ready to go ahead and start the tax collection process. Okay. Go ahead, Bench. Registration requirements. So in most cases, your business is going to need to have an employer identification number. You get this from the IRS by filling out Form SS4. If you are a foreign seller, a foreign business who's registering directly rather than selling through a subsidiary, you will typically need to get an EIN number issued for your foreign entity. Commenda can assist with this process. We do hundreds and hundreds of these Form SS4s and EIN applications because we do incorporations as well. So if you need assistance getting one, we can certainly do that for you. A handful of states also require what's called a foreign qualification or a certificate of authority. So this just means that you need to get a certificate of authority before the state will even issue you a sales tax permit. It's typically done through the same portal in the same sort of tax portal that the state will set up. You can get the foreign qualification and the sales tax permit at the same time. A few considerations for international companies. A handful of times there might be a case where you need to fill out a paper application if you're an international company. This is less and less true these days. Typically, you can get online these days. You typically do need a U.S. phone number and a U.S. mailing address. Commenda can provide those for you if you do need those. And lastly, in a handful of states, you do need a corporate officer with a social security number or an individual taxpayer identification number from the IRS. These if you don't have a director that has one of those, Commenda has created what we call a responsible party service, where instead of listing one of your officers or directors on the registration, Commenda will provide what we call a responsible party for you that will be listed with your registration. The benefit of this is that it's a lot faster. Getting an ITIN issued for a foreign director can take 2 to 3 months. It's really a pretty onerous process. So that's why we came up with this service, because we have such a focus on international sellers who are just expanding into the US. We created what we call this responsible party service, where instead of you needing to provide an officer with an ITIN or SSN, Commenda can provide one on your behalf and will be listed on your registration as a responsible party. So just wanted to point that out. It's something kind of unique that you won't find that other solutions provide, because they're mostly dealing with domestic sellers. Go ahead, Benj. So like I was saying, all the different questions that you need to figure out in order to determine the appropriate rate of tax to collect on an invoice. These are sort of all of the things that Commenda's tax engine is figuring out every time your system is raising an invoice, whether that's in an online checkout or whether it's in your your invoicing or your accounting tool. We're looking at the origin address, the destination address. Is it interstate or intrastate transaction? Is this an origin or destination-based tax scheme? Are you registered? Will this transaction exceed the nexus threshold? Is the product or service taxable? All these little things need to be answered before we can determine whether to apply tax on an invoice. And certainly you can do this manually, but beyond a certain scale, you're going to want a solution in order to assist this process, because it does get pretty onerous to do. And it really throws a wrench in your sales process, right? At the end of the day, your company exists to make sales, not to calculate sales tax. It's nice to have a vendor that can assist you with this and make it as easy as possible. Go ahead, Benj. So once you have an obligation to report because you've gotten a sales tax permit, of course you need to do filings. If you're a very, very large seller, you might have a prepayment obligation. This typically isn't relevant for most businesses. If you have physical locations in a state, you might need to prepare what we call a supplemental schedule. That's like by location, for example. So if I'm Taco Bell, I've got 20 locations in a state. Some states are going to require that I break out sales by location, for example, and that's what we call a supplemental schedule. And then, we had a question earlier about whether you need to break out the tax by jurisdiction on invoice, county, state, municipal, etc. The answer is no, you don't need to break it out on the invoice, but you do need to report it correctly to the state. And so that means that you understand, which element of the tax needs to go to which jurisdiction, that you can figure that out on reporting, right? So to the customer, no, you do not have to break that out, but you do need to consider it from a reporting perspective. And lastly, the thing I'll mention is that in order to pay sales taxes to the state, to remit it, you need to have a U.S. bank account. So either we can assist you in setting up a U.S. bank account. We have a few, friendly banks that we work with, or if you, we have some foreign sellers that use like Wise or Payoneer in order to have an ACH account that they can fund their U.S. sales tax remittance with. Looks like we have a question. Could you please confirm whether the U.S. has any annual revenue threshold that requires a foreign business to register a U.S. company? Specifically, I want to understand whether exceeding certain sales levels triggers mandatory entity formation, or whether only state-level sales tax nexus thresholds apply. So there's no threshold, specific like revenue threshold, that would require you to create a subsidiary or an entity. There are state-level thresholds for sales tax registration. The only sort of revenue-based threshold is going to be actually, I'm sitting in Washington and Seattle right now. There is what we call a business and occupancy tax here, where there is a revenue-based tax that's applied. Now, there is sort of a broader concept in the U.S., and there's an acronym for it called ETBUS, which stands for Engaged in Trade or Business. Again, this is similar to concepts of like permanent establishment in foreign countries, where if you were considered to be engaged in trade or business in a state, that will create certain types of corporate income tax obligations for your business, but that's all very separate and distinct from any sort of sales tax obligation that you might have. Would having a sales partnership channel in the U.S. market require us to apply for a foreign tax number? I'd want a little bit more detail about the nature of the partnership, but oftentimes, yes, it would. The real question is who is the seller of record on the invoices going to your customer? Is it the sales partner, or is it still your business? I think that's sort of the key question. So Commenda offers a lot of automation solutions around all of these sales tax topics. We do free nexus tracking for your business. You don't have to think about it. We'll send you alerts whenever it's time to get registered proactively. That way you're on top of it. You can start tax collection process in a timely manner without ever needing to, get caught with penalties or interest. We do all of the filings on your behalf as well. So our head of filing operations here at Commenda is the former indirect tax manager at Amazon, super guy, total expert, and we do all the filings on your behalf. We'll also do the registrations on your behalf as well. And lastly, like I mentioned, we can do the real-time tax calculations, whether that's integrating with your online checkout experience or with your accounting software or ERP. We have direct integrations with most of the big ones and can set this up pretty seamlessly. Go ahead, Benj. Last thing I want to highlight is that we don't just offer solutions for companies or sellers. We also do work with a lot of accountants and tax professionals as well who are looking to sort of offer sales tax services without necessarily taking on the overhead. And we do offer some unique solutions as well for drop shippers and B2B sellers. So if you fit one of those cases, please feel free to book a call with us. Totally free. It's no pressure. We have experts who can talk to you about your business case, figure out what's right for your scenario. Look forward to speaking with some of you on a call soon, and hopefully we can help you get set up for sales tax in the US. Looks like we had another question come in. What happens when foreign staff are sent to the US to perform services over a prolonged project, and so thresholds are triggered? Will a foreign registration be required? It is state by state, but in most cases, yes. If it's sort of a temporary project or service, there are states that will allow you to get a temporary sales tax permit, and then as soon as your business or whatever your project is done, then you can deregister, but you should be registered for the duration of that project. And so in most cases, I would say broadly, yes. You'll want to look at exactly what's going on and also the nature of that employee as well. Typically, employees who are in marketing and sales will almost always require a registration. If you're sending people for sort of a non-sales purpose, oftentimes there is no registration. So it does sort of depend upon the purpose of that employee as well. Great. I mean, that's it. Please, we'll hang around for another minute or two to see if there's any additional questions. Feel free to put them in the chat. Otherwise, you can book a free consultation with one of our experts. I might see you on one of those calls, or you can talk with someone from the Commenda team more broadly. Commenda does do a variety of different webinars on different expansion topics globally, on other tax concepts around transfer pricing, incorporation, corporate structuring, things of this nature. So do look out for our other webinars, and we look forward to speaking with you guys soon. I think Benj will follow up. We can provide a PDF of the presentation, and he'll send a follow up as well. So if you're interested in talking to one of our experts, we can get that set up via email. Thanks everyone for attending.
Thank you.
All right, everyone, have a good day, or wherever you might be.